You watch a major resistance level break. You execute your buy order. Almost instantly, the chart plunges, wiping out your position and hitting your stop loss. This rapid reversal occurs because the market has successfully accessed the specific volume required to fill much larger orders. What looks like a failed breakout is often a systematic process of capturing the liquidity needed for a move in the opposite direction. Many traders find themselves providing the capital for these moves by entering exactly where institutional orders are waiting to be filled. To find more reliable entries, we have to look past simple support and resistance and identify two specific zones where high-volume orders cluster: external and internal range liquidity. We'll start by opening a 15-minute chart for the Nifty 50 or any high-volume index. Locate recent swing highs and lows, drawing horizontal lines across these peaks and valleys. These represent logical points where participants place stop losses, just above a high or below a low. These zones of accumulated resting orders are known as external range liquidity, or ERL. Large players require these pools of resting orders to execute significant positions without causing excessive slippage. They need your stops to be triggered to provide the necessary counterparty volume for their own trades. By mapping the ERL, you can see where the highest concentrations of capital are sitting before the market makes a move to collect them. When price approaches your ERL line, the common reaction is to trade the breakout. However, we look for a liquidity sweep. This occurs when price pierces the level, triggers resting orders, and rapidly reverses. To confirm the sweep, the candle body must close back inside the trading range, leaving an elongated wick extending past the ERL boundary. That wick shows where the market momentarily expanded to find volume before the direction shifted. While the retail trader is forced out as their stop is hit, a smart money strategy involves waiting for the specific rejection to occur before considering an entry. Recognizing the sweep turns an apparent breakout into a high probability signal that the market is ready to move in the opposite direction. Following the sweep, we must immediately look for a sharp, aggressive price move cascading rapidly away from the established level. This momentum often leaves behind a structural imbalance called a fair value gap, or FVG. Identify an FVG by looking at a sequence of 3 candles. We look for the vertical space where the wick of the first and third candles do not overlap. Draw a box to fill this gap. This is our internal range liquidity, or IRL. The market tends to retrace back into these gaps to offer execution at prices that were skipped during the initial surge. This gap provides a structural entry point, allowing you to align your trade with the momentum of the market's rebalancing move. To execute, we place a limit sell order at the boundary of the fair value gap. The stop loss is placed just above the tip of the wick that created the initial liquidity sweep. Our objective is based on a consistent market delivery cycle. Price moves from internal liquidity to the next pool of external liquidity. We set the take profit target at the previous swing low, which serves as the opposing pool of ERL. The entire process is systematic: a sweep of the high to find volume, a drop that creates an internal gap, and a retrace to that gap before price expands to the next low. This framework replaces vague intuition with a sequence of objective triggers, providing a clearer way to manage risk. Success in the Nifty 50 requires moving away from the crowd and waiting for the market to reveal its intent through liquidity. This sequence repeats as price moves between these two states, clearing external zones to find volume, then rebalancing internal gaps to prepare for the next expansion. Open your charts now. Your objective is to identify 3 historical examples where a sweep of a major high or low led directly into a fair value gap. Once you stop chasing breakouts and start waiting for sweeps, you stop being the source of liquidity and start trading with it.